Okay, we're going to go ahead and call this meeting to order. This is the City of Palatka Police Officer Pension Retirement Plan Committee meeting. And so at this time is our pension board meeting. And we'll go ahead and start this meeting off with a roll call.
Mayor Hill,
Here.
James Norwood, Scott Nast,
Here.
Matt Newcomb,
Here.
Greg Cummings is absent today.
Okay, show that we have a quorum.
Yes, we have a quorum.
And let's go ahead and get started. We'll have approval of our minutes from our prior meeting. Has everyone had an opportunity to review those minutes? If so, I'll entertain a motion.
Motion, we accept the minutes as presented.
Second. So motion for the second. All in favor, say aye. Opposed, motion carries unanimously. Next up, Sawgrass. There's fine. Yeah, you wherever you want to be. You can be in either one. You can sit down if you want. Just hit your mic for me.
Good afternoon, everybody. I'm Leonard Gita, portfolio manager at Sawgrass Asset Management. First of all, I'd like to thank you again for the business, for the opportunity for us to manage part of your portfolio. True honor for us. Today, I'm here to talk about the quarterly review, the third quarter and the year. Before I talk about the numbers and what we see in terms of the outlook going forward, I'd like to just kind of give you a brief summary in terms of what's been going on this year. Obviously, on the fixed income side, it's been a truly historic year from a performance standpoint. We've never seen anything like this from a total return. We've seen previous years, we had high periods of inflation where we see high, big jump in rates, but from a total return, because we started at such a low level of nominal rates, the hit in terms of the total return has been truly historic for the ag, for all of the fixed income asset classes. Obviously, the main culprit of that move was the inflation, the big rise in inflation as a result of the policies that we made during the COVID. We still kind of working through those issues that basically is a derivative of that event. The aggressive fiscal policy, monetary policy, and coupled with lots of issues from a supply chain perspective, et cetera, did create this problem, this temporary problem. And so we're kind of working our way through, but it's no doubt that it's been a truly, historic return for the ag. As of September 30, you done with me on page 9.
Excuse me,
Yeah.
before you go on, because you kind of brought it up.
Yes.
Inflation, and I know the Fed's probably raised rates again today. Do you see an end to inflation at the level that it's at today? Do you see it coming down at any point in the very near future?
Absolutely. And we're in the camp that everybody hates the word transitory because the Fed started using it last year. They were a little bit early to that game, and then they basically stopped using it. But the nature of this inflation is not really like the 70s that we experienced, where we had that acceleration year after year. It's a little bit different this time. It's more, as I mentioned, these transitory forces, the supply chain problems tied to China and the rest of the globe. The big jump in the commodity prices, a lot of those commodity prices have come down quite a bit. We saw lumber go from 400 to 1800. Now, well, guess what? Lumber is down to close to 400. Shipping rates, the one container rate from the Lombard port to Shanghai used to cost $2,500 per container. Well, during the peak of the COVID friction, that rate went as high as $27,000 per container. And then so that's come down to not only pre-COVID levels, it's actually below that. It's down to $2,000. So a lot of these big moves will make their way into the goods, the consumer goods that we do consume.
Okay, I guess the problem that I do have, the thing that I'm noticing is 6 months ago when they actually started raising rates about the beginning of this year. But 6 months ago, they said, well, we got it under control. It should be under control. But we've had, 3 rate increases since then, interest rate increases?
We've had.
Seems to be different.
Four big
Right.
ones, 475. 75, that's. It started with 25 and then 50 and then quickly to 75. So 125, 150 and then 470. Tomorrow is expected to be another 50 on top of that.
Okay, it just seemed to be hard to get it under control
Well,
this time around.
the policy works with long variable lags. So like the actions that you're seeing today will feel that in the next, say, 12 months or so in the real economy. So what we're feeling today is that is some of the actions that they took, 8 months ago or something, 12 months ago. So we're starting to see some of the effects. But if I look at the leading indicators, for example, the CPI numbers that came today, a big market moving event, they came at much less than this. Everybody was anticipating the numbers today, while the CPI, the core CPI that excludes the volatile components of that basket, which is energy and these are the volatile parts of that basket. They came at much less than expected, 0.2% less than the estimate. So that number is coming rapidly, much less than what all the economists were originally anticipating. So it's proven to be what I just said, that it's going to be, at the end of the day, it's going to be somewhat more of a transitory than this persistent high inflation that we saw in the 70s. We're not, the economy today is not the economy that we saw in the 70s.
Okay, may I ask a follow-up to your very insightful question? How much of this inflation do you think is due to China? Just China?
There's been studies out there, but there's a big contributor to that. Because China, whether we like it or not, being an adversary, it is, at the end of the day, it is really integrated into the supply chain of a lot of the goods that we consume. So having this huge friction, not having the supply chain available, a lot of these companies have had problems with inventory, and that has definitely created a friction into the pricing, at least in the near term. And the tariffs did contribute, not significantly, but they did add to the inflation. The biggest source of this inflation bump was really the aggressive. It is a once in a century event, but the policy reaction did contribute a lot to this big wave here, because you had this merger of the fiscal policy and the monetary policy. Fiscal policy, we added over $5 trillion of debt to our balance sheet, and that was monetized. So it wasn't a pundit; it was completely monetized by the Fed. The Fed added another $5 trillion to the balance sheet. And all that money, unlike the great financial crisis period, where the money kind of stayed into the banking circuit, this time around, that $5 trillion hit the real economy. Everybody got stimulus checks, the PPP loans, all the industries, the auto industries and the airline, everybody got a bailout check. So everybody got, it was the first recession that people had more money in their bank account than before recession. So do you call that a recession? That was the recession that we faced. So
one question to follow up Roger's question is a year ago, I would say, a year ago now, the Ukraine war made a contribution to the inflation, just because we invested so much into that war as well. Now it's on the back burner, so to speak. It's not as noteworthy now as it once was. So therefore, is it still contributing at all to where we're at as far as our economic culture exists?
it is contributing, but not as much as the initial hit, your
Okay.
point, right? So we had that unfortunate chain of events where right after the COVID, as soon as we got that little bit of break with the vaccines and all that being rolled out, we thought that everything was fine and we're going to get back to that normal inflation that we've seen before. Well, we just got the biggest war in Europe since World War II. And it just so happened to include the two biggest producers of the agricultural commodities, right? You got Ukraine and Russia. They are the biggest producers of grain and potash and all these agricultural derivatives. Well, that did affect all these ag prices, and food is 10% of the CPI. So you had this double knockout, if you will, from an inflation pressure standpoint. But the biggest hit was actually last year. Now, at the rate of change, the market is not giving it a big of a premium as it used to. So from a going forward perspective, I don't see that being a persistent pressure, for a CPI from an inflation pressure standpoint. So.
So this new round of COVID that's coming through now that, is affecting the country, and it's going to probably be nationwide, probably in the next couple of weeks or so.
It's gonna be a light flu. It's not really changing the dynamics. The biggest news that we've seen in the last couple of weeks has been the big 360 that we got from China. So China was the biggest weak link of the chain by being very strict with their policies, where they would close 20 million people city just for a small number of cases. And that would affect the entire world supply chain. Well, now they're actually coming across and they're changing that policy, and it's having a big effect in terms of how the world operates. And so now they're actually becoming very lenient with that policy, and they're opening up their borders as well. So that will affect the supply chain, reduce the pressure even further to the overall global inflation picture.
Mr. Mayor, I'm done now. I'm not going to ask about
No more last question?
the immigration that's going on right now. California, how's that going to affect our economy as well? All right, but that's okay. Thank you, sir.
I think, basically the inflation is, you got two components. The consumer goods, we already went through that big pressure. If you look at the leading indicators, I talked about the shipping rates, commodity prices coming down, housing prices are coming down, other leading indicators, the ISM data, new orders, they're contraction territory. So we had this big wave of consumption that did take place the last couple of years. Well, we have already exhausted that. So going forward, you're going to see this new wave of not so much consumption. So that's going to hit down the price. On top of that, a lot of these big retailers, Walmart, Amazon to the world, they over order thinking that they're going to have this huge persistent demand continuing. Well, now because they're flooded with inventory, right? So they're going to take a lot of price cuts to clear the inventory. So that's going to make their way into the pricing. So from a consumer goods perspective, we're not worried at all in terms of the inflation going forward. The problem will be with the service part of that. It tends to be sticky. Healthcare, education, owner's equivalent rents, which is a derivative of the housing. So housing is coming down, but the rents are not as quick to follow that trend. So it's going to work its way into, but again, it's not going to be as problematic as it used to be a couple of years ago. So long story short, we've had bad inflation that has trickled into, has forced the Fed to become very, very hawkish. To your point, they accelerated the policy tremendously this year. And that caused the market to reprice the rate path and caused the huge negative print for the bond market. So on page 9, if you look at the index, I call it the S&P of the bond market, the Bloomberg Ag Index. Bloomberg Ag Index as of 9/30 finished the year down 14.6%. That has never happened before. So that's the result, in terms of the historic event. These types of numbers you never see in the bond asset class. The bond asset class is supposed to be your anchor, your safety, and this time around it was the opposite. It was the source of negative returns. But we think that going forward, if we're making the case that the inflation has peaked, and now all of a sudden your portfolio, let's go on the page 16. This is the current portfolio as of 9/30. You can see at the top, the yield on the portfolio is at 4.9%. Let's call it 5%. That is a great return, a great yield going forward. So you're finally getting paid to have a very high quality asset class, a true diversification provider to your total portfolio. And now you're getting paid 5%. So you took a hit, say 14% down, but you're yielding 5% going forward. So you will make that loss in the next couple of years. And because of your long-term objective and mandate, you're actually better off having these high rates, because you'll make up this loss in the next couple of years, but going forward, you'll be accruing at 5%, assuming rates still move. So from a pension plan perspective, you're actually better off having higher nominal rates. Initially, you take the hit, but going forward, because your carry is so attractive, you're better off having these types of numbers. But since these numbers, the 930, which happen to be the low in terms of the price returns and the high of the yield, we've had a big rally in the bond market. So your portfolio is down close to 10% now year to date. So we've had about 4.5% rally since the end of September. It's big. We've seen this huge volatility in rates. We've never seen anything like this before. So with that, I would just say, we're trying to be a little bit active at the margin. We've added some exposure to mortgages. We think that's a very attractive sector within the fixed income asset class. You're finally getting, a decent spread at a very substantial discount in terms of price. And we think that's a good carry alternative in this type of environment. You've got no credit risk, but the main risk there is the prepayment risk. But if you're buying at an 85 cents on the dollar, you're shielded from that prepayment risk. So we think that's a good risk return sector within the fixed income asset class. So at the margin, we're being a little bit active there. We have outperformed the benchmark on the way down and also outperformed on the way up in this recent up move. So we're basically staying close to the index given the tremendous volatility that we're seeing in the market, but at the same time generating some positive return. With that, I'll conclude my brief presentation. Take any other questions if you have.
Any questions based on what you've heard thus far? Commissioner, go ahead.
No, I have one more question. If I may. Can you explain to the trustees how the bond portfolio has a built-in sort of healing process whereby the income that's generated, how when it's reinvested into the higher coupon issues, how that eventually heals this 10% loss you're talking about? Give them a sense of the mechanics of how that works.
Yeah, so the return is comprised of two components, right? You've got price change plus the carry. The carry is the coupon or the yield. Sometimes you can buy a premium bond, say 105 cents on the dollar, but you get a much bigger coupon. So that coupon is your difference between the price and the coupon. That's your yield. That's your carry. That's income. So the two components of the returns are price change and the income. Well, now you've taken a big hit on the price change, but the income has gone significantly higher. From the low 1%, now you're talking 5% income. So even if you have another wave of rising rates, the income is so big that it would actually shield you from further price declines in terms of total return. Does that make sense? And then going forward, if we have kind of reached this exhaustive point of further rate hikes, meaning we're not likely to go further higher, much higher from these levels, then it turns into a double positive where you get a positive high income, but if rates starts declining a little bit, you also get a price appreciation from that standpoint. So you get this double positive going forward. So that is the beauty of the fixed income part, is that yes, you're taking a little bit of hit, but the carry will work wonders given these new rates. And in just a couple of years, you'll be at a much better financial position.
So that leads me to this final point. Jill, are we at 7% now here? That was recommended. Is that where we are, 7.25? Okay. So is it possible, because we're talking about this now with you with other clients we have in common, is it possible that you would be able, could you build a portfolio, let's say 12 years or 13, 14 years in from there, where with a yield of maturity of around 7%? Is that coming?
It's not doable at this market.
How close are we?
So right now we were at 6% on that type of maturity bogey. Now that market has gone down to low fives.
Yeah, it's come back a little bit. Okay.
The spreads haven't really moved a lot, maybe around a little bit, but I talked about the rally since the 930 numbers. The 30-year you're looking at a 3.5% number. So the average spread for that type of maturity is roughly 150. So it's kind of hard to get to about 7%.
Well, you know where I'm going with this. If the Fed does was a 50 beep increase tomorrow, and let's say they do another one in January, will we be getting closer to 7%?
The market has already priced that in. So
Okay.
whatever Fed does today, it's already priced in.
Okay.
The Fed funds futures market has already priced in a 5 and 1/8 Fed funds rate. So unless the Fed moves higher than that goal, then the market will actually reprice that new variance. But if the Fed prices the 50 tomorrow and another 25 the next meeting, that's already priced in. So in other words, it's not supposed to give any additional change to the current.
So we don't know what's going to happen, but what we're hoping for, if rates do go up enough to where Sawgrass can build a portfolio that's getting closer to 7, it would be a big win for the city because you can essentially immunize, de-risk is a better word, a big chunk of the city's obligation. If that interest rate environment, if we can strike it when it's hot, and it may be, we'll see. We'll have the same discussion in March, I guess. If something happens in March where it looks like you can get close to 7%, and we're talking yield to maturity now, where your average cost maybe is at or below par even.
Some of the bonds are trading at 65 cents on the dollar because they were issued, say, last year at very low coupons. But the yield, to your point, that's the key number. It's, if you can get a 7%, to your point, I mean, that's a great return that you can lock in for a longer dated maturity. That would be a great investment option.
And when was the last, let's say, is 6 doable, perhaps?
6 doable if you really go way out in the risk curve.
Well, and we're looking at more
And I would
credits.
advise to take,
Let's say more credits.
right, credits. I'm talking about credits.
Okay.
So if you have 100% credit only portfolio and you were to lock in that type of maturity, you'd be looking at low 5s at this market.
Okay, well, we'll keep the discussion going. Okay, thank you.
Okay. Any further questions based on what you've heard? If not, I entertain a motion to accept this report.
A motion we accept the Sawgrass report is presented.
Second.
There's a motion on the floor in a second, and all in favor, say aye.
Aye.
Opposed, motion carries unanimously. Thank you.
Thank you.
Capital City.
There we go. Dwayne Madron, Capital City Trust. Good afternoon. We have in front of you a booklet that looks like this, and it's up on the screen. I'd like to go to the first page, which talks about the positioning of the pension fund and its policy and its actual. So now we have ranges in our policy, and they're on this page. And the second column over that says percentage of total market value, that's the actual percentage as of November 28th. So I'm in within range, small correction, real estate slightly out of the range, but that was corrected last week and brought up within range. But as you see, large cap equities are higher than international, which is where we've been for some time because business fundamentals in other countries are not as good as America. And for instance, the inflation in Europe is much higher than it is here. And then China has their COVID restriction, which has caused their economy to slow down. And the economic growth in Europe is just not as good going forward as ours is. They're having a lot of difficulties, just like we are with supply chains, and they're affected by the Ukraine war more than we are. So nevertheless, there's still an overweight to large US companies in this portfolio. There has been for some time. Pardon? 21.9. Right. It's underweighted versus the policy, but it's more than international. So at some point, international may come up to be the nominal target of 15, but it may be some time before that happens. The rest, and I'm trying to keep the portfolio position right on the policy percentage unless I have a strong reason not to. So the other asset classes are pretty much right on target. But in an abundance of caution, I left fixed income overweight a little bit because of its defensive nature going forward into this so-called recession that may be coming up. So fixed income is a little overweighted. The downside there is probably less than the downside in equities. So that's why fixed income is a little bit overweight. So in general, as you probably know, and as Sawgrass has already touched on, not a good year for investing. You know, bond market is bad. The stock market is down 15% through the end of November. Your fiscal year number is not good. This is just simply not a great year for investing because of the rate increases. And the rate increases were designed to slow down the economy. He's trying to choke demand. Nevertheless, when rates go up, historically, stock valuations fall. They act in inverse to each other. So this growth environment that we're in this year is much, much slower than it was last year. GDP growth last year was about 6%. This year, it's about 1 or less. So stocks are readjusting their valuations to reflect the new growth climate that we are in. So we are in a slow economy. Last year, we were in a fast economy. So stocks aren't necessarily losing money. Companies are making money. They're just not making it at the same pace that they were last year. So to reflect that, valuations have come down. At some point, the economy will start growing again faster and valuations will come up to recognize that earnings are growing again. That may be a while. It may not be till next fall when rates maybe will come down. We're not sure yet. So nevertheless, expectations for 2023 should be low. Stock returns might be as high as 5. Bonds may outperform stocks next year. Certainly, bonds are cheap right now, as Sawgrass was alluding to. So meeting the actuarial return in the next fiscal year, in my opinion, is going to be a challenge to meet 7.2. I think that's what it is. Nevertheless, the way to do that is to be overweight in equities because that's where the growth is going to come from because bonds don't grow. They throw off income. So we're still overweight in stocks versus bonds. That's where the growth is going to come from. There's no questions. I'll go on to the next page to account performance through the end of September 30th, which is the third quarter, which is why we're here. Now, this is the combined equity portion. This is not Sawgrass. This is the equities plus the high yield bonds, and infrastructure and private real estate are not included in these numbers. So for the quarter ending 9/30, the total fund was down 4%. Year to date, it's down 22. The equity portion was down 24.6 year to date, behind the S&P 500. Primarily because we have some money in small cap and international, and that did not perform as well as large cap. So that's why the returns over the last 1 year and year to date are behind the S&P 500. We like to be above the S&P 500, and in up markets, we usually are. The taxable bond line is the high yield bonds, which are down 13% year to date through September. That's because they tend to act like equities. And then real estate is down 28 because real estate is affected not only by rising rates, but a lot of people are working from home. So offices are starting to hurt a little bit because there's nobody in the office. So they're not renewing their lease. So they're working from home. Humana is one example where the call center people are now at home. They're not in the office. So nevertheless, the equity portion, for the quarter, -4. And September was just an awful month, a bad way to end the year. October was a great month. November was a decent month, 5%. December sort of, waffling in the middle. I guess, the new fiscal year, we're off to a decent start. Probably equities are up about 11. So that's a good start. We're not done yet because there's 3 or 4 more rate increases coming. So we'll have to see what effect that has. The next page over is the returns through October. So you can see where October being such a good month, equities were down 22.5. They came up to 17.6. So we stayed fully invested as we usually do. And we realized that 1 month that made a lot of difference. And so it's hard to time the market. We stay invested and we catch the good days, because if you miss the good days, it's hard to catch up. The next portion over the asset allocation is a snapshot of the fund without the private real estate and the infrastructure. So it's 62% in equity, which includes the convertible bonds. But Burgess, if I include the private real estate and the infrastructure, I'm probably close to the cap. I'm about 72. So I'm probably on the verge of reducing equity and moving it to Sawgrass, because I'm bumping my head on the cap. So still a moderate growth portfolio on the, not aggressive, but still a growth portfolio that is above average. Say the car is in 4th gear out of 5 years is how I like to describe it. The rest of the report is the snapshot of the mutual funds and the Sawgrass CIT and the high yield bond fund and the Vanguard real estate fund. Really, do you have any questions for me?
As culture change within the workforce and people are working from home and people are not renewing their leases on office space and whatnot, how are you guys adjusting that in the portion of the port in our portfolio?
Okay, the Vanguard real estate index that you're invested in,
Mhm.
it has a portion, it's well diversified. It doesn't have a lot of offices. So the way we address this is to be broadly diversified. So apartments are doing well. Public self-storage is doing well. Healthcare is doing well. Retail is doing power retail centers like a Best Buy next to a Starbucks. That's doing okay. The malls are not. Hotels are coming back because people are traveling again. Most of the portfolio is okay. Some of the offices are going to suffer unless they had long-term leases, like Boeing has a 30-year lease on their building, but other offices that had a 3-year lease may not renew their lease because the employees may be working from home. So the way we approach that is to own all different types of real estate, not just offices. So
I guess we identified office space as culturally is not doing as well as it has in the past. And just wanted to make sure that we, in that area, just the office space area, if you guys need to make any adjustments and that kind of thing to reflect that within the portfolio.
I don't think there's
You
a
answered
need.
the question. You said no at this time.
No, I don't.
Everything
No.
else is doing well.
No, it's so well diversified that I don't need to make any changes because the parts that are not working are offset by the parts that are working. So I guess what I'm saying, we ride it out because it's so well diversified that one part that's not working doesn't kill you.
Okay. Richard's going to tell us how long should we ride it out though.
Any other questions?
You've heard the Capital City report. I entertain a motion at this time.
I'm not sure we accept the Capital City report as presented.
Is there a second?
Second.
There's a motion on the floor and a second. All in favor, say aye. Opposed, motion carries unanimously. Thank you.
Thank you.
BCA.
These two gentlemen are so well informed and so smart. I'm not sure I can have anything. But I'll try.
You've heard the report from BCA.
Yeah, basically. But let me just talk about real estate for just a minute. If you go in my book to page, the page is supposed to be numbered here. Interesting. It looks like this. It's the allocation page. This is,
Okay,
I'm gonna guess it's 1, 2,
actual versus target allocation.
actual versus target allocation.
Page.
Are your pages numbered?
Yeah,
Yeah, they do this to me. They love this to me. No, I got it. Thank you. So you were talking about REITs. You can see that you have about a 2.7% allocation versus the target. But you also can now have private real estate with American, which was funded October 1st with 860,000. And that's 7.8% of the, so roughly 10% of the portfolio is in real estate. Now, I was at a conference, can't remember where it was, maybe in Naples about 8-10 years ago. And I actually said that real estate is one of the best asset classes for a pension plan because over time, the volatility tends to be very low and there's a lot of income and you have real assets as opposed to paper. So there's plenty of assets and the leverage in the REIT program is very low and the leverage in the private real estate is only about 20% leverage. So very conservative. There is repurposing going on with office right now. Some markets are being converted. I was in Boston just a few weeks ago. Central Boston, and you can see big towering office buildings that are being converted into workforce housing. And there are traditional malls that are being repurposed into apartment buildings. So there, a lot of smart people are in real estate, like Mr. Chairman of this plan. And they're nimble. They can shift around when the market puts pressures on them. And I think the real estate is going to do just fine. This was said just a minute ago. International since October is up about 18%. It's actually outperforming large cap. And I read something this morning that helped me better understand what's going on. Europe is very cheap for Americans. The euro, when I was just there, was 95 cents. Now it's up to about $1.05 again. And the sterling is cheap. It's very great time to go to Europe. And Americans are spending money like crazy. This article said that the high-end goods, clothing, shoes, cosmetics, perfume, purses, leather goods, sales year over year are up 40% in Europe because Americans are going over and spending the money. So we're keeping Europe alive. Are they in a recession? They are in a recession, and this will maybe make the recession not as deep. And something that was mentioned last time was that the Fed, the money supply, the M2 money supply was increased by 40% in that just 2-year period we were talking about. That's a tremendous amount of liquidity that was put into the system, and it's going all over the world. It's going to Europe, it's going to China, it's all over the place. We're spreading the wealth. And so that in part explains why the European stock market index is up so much. It's ahead of the US. I think I also pointed out last time that the last meeting there was a 14.5-year run where US stocks are outperformed foreign stocks. And so, there's been questions raised, why do we even own foreign companies since the US has done so well? Well, US stocks are still selling at twice the price to earnings multiple. And the yield component of foreign stocks is still very compelling. You should keep the international. It's a very good buy. Wouldn't you agree with that? And so while some programs are distancing themselves from international, I'm glad you've stuck it out because you're doing very well. The other thing I want to mention to you before I summarize on page. It says total fund summary, this page. Should have taken you up on your offer. Total fund investment summary. And I've said this before, this plan is, with the exception of the private real estate, is liquid. Everything's liquid. We know it's, everything's worth, everything's mark to market. Page 5. Thank you, sir. There are a lot of pension systems around the country that own private equity, lots of it. They've invested in stuff that no one really fully understands what it's worth. And next year is going to be a year of rude awakening, where a lot of repricing, a lot of marking down of those programs is going to occur. It's going to occur next year. So there are pension systems that are showing exaggerated returns because there is no pricing mechanism to bring those prices down quickly. The pricing mechanism, price discovery mechanism is very gradual, very slow, because two reasons. One, they use outside third parties to value the assets. Let me ask you something. If you have a company, a private portfolio that say has 50 companies, how do you evaluate a full service company? Well, you take a projected cash flow and use a discount rate, you come up with a net present value, I guess. But that pool company, pool chemical company, the only way to know what it's worth is if someone buys it. So all of those pricing calculations are all estimates, where by and large, everything here is done on a mark-to-market basis. The market is pricing what these things are really worth. The private real estate will go through a little bit of a markdown next year. But given the nature of American Realty, the type of capital structure they have, namely only 20% of the capital is debt, the rest is equity. The impact on you will be de minimis. But there are other funds like BlackRock is a very well-known private real estate program that I think is up to 50% leverage at one point. You don't have that kind of exposure with your real estate. Any questions? No? Okay. That's all I have today. Yes, sir. Anything else? You don't get any older. How long have I known you? 20 years? You don't show any age. That's true. Don't you agree? Doesn't age, does it? You all have a nice Merry Christmas, okay?
I make a motion to accept the report as presented. Second. Second, all in favor, say aye.
Counselor, I'm sorry.
Hi, everybody. Can everyone hear me okay?
We are.
Okay, great. Okay, so I see the first one that you pulled up is the Public Safety Officer Support Act of 2022. This is an act that was just passed, which directs the PSOB, which is the Public Safety Officers Benefit Program, a federal benefit program, to label disabilities from PTSD and acute stress disorders resulting from qualifying traumatic events as work-related injuries. This previously was not the case. This line of duty designation will also extend to public safety officers who become permanently disabled as a result of attempted suicide. So it will cover death benefits and permanent disability death benefits in certain cases. It also allows the families of officers who pass away from induced suicide to apply for these PSOB benefits. Previously, these wouldn't have been designated as line of duty. That has now changed. So, we are, I don't want to say happy, but we're satisfied that this is now, will be considered a work-related injury.
Any retroactive component to it?
I believe it's going retroactive to 2019. So January 1st of 2019.
Okay.
So any claims that were submitted for PTSD or suicide related deaths that occurred on or after that date. So, hopefully those entitled to benefits, will apply. And if there's ever any member or someone that you know about, I submit applications pro bono. I'm familiar with the process. So, if I can help out in any way, I'm happy to do that.
And that's for all first responders?
That's correct.
So I know we'll have at least one.
Okay, so, if a spouse or a child needs assistance, I can certainly provide that.
Okay. Any other questions or comments as relates to these Public Safety Officer Support Act? Okay, move on to the next part. We don't need to do anything to accept.
No, correct.
Right.
Just informational, but if anyone has any questions, it's a good resource.
Okay, next up, Delaware law change.
So a recent Delaware law change, it's been about 40 years. Corporate statutes permitted corporations to include provisions in company charter to protect the members of corporate boards from personal liability. We are okay with this, but now the change, it will be that they can essentially opt out of this by revising their charters, and they can no longer be held responsible. So because boards, don't vote their own proxy, we suggest that if you don't have a proxy policy already, we can make one. If you do have one in your investment policy guidelines, we recommend adding this language, and also just informing each manager that we are recommending that they vote against this proposal to allow for a shield from personal liability.
Okay. Yes, sir.
Mr. Mayor, I move we adopt the language under Delaware law permits companies to insulate corporate officers from liability for reckless conduct. I move we adopt the language that has been recommended to us and add it to our policy.
Okay, there's a motion to adopt identification language. Is there a second?
Second.
It's motion on the floor in a second. Is there any further discussion on the motion? All in favor, say aye. Opposed, motion carries unanimously.
Make a suggestion, because we're dealing with the same issue, important issue with other clients. Anna's office is working on language for an addendum.
Letter, yes.
And I would suggest that we just change the investment policy. We could make this document an addendum to the existing policy. And then later on down the road, when the policy is, say, updated again, then we can incorporate the addendum. Is that okay, Anna, with you?
Sure, that's fine.
Okay.
Okay, so right now, just adopt it as an addendum, and then next time we update the policy,
Yeah.
we'll include it. Okay.
Be administratively easier for everybody.
Sure.
Move we adopt it as an addendum to policy.
And then subsequently change the language. There's a motion on the
You okay
floor.
with the addendum?
Yes.
Okay.
Is there a second?
Second.
All in favor, say aye. Opposed, motion carries unanimously. Thank you for that. Next up, is proxy voting.
Lastly, this is more just informational. The SEC adopted a rule to make proxy voting for mutual funds more transparent to investors. So they're utilizing a computer format, a standardized order of information disclosure. They're disclosing the number of shares voted, the number of shares loaned, et cetera. This is being done to allow investors to better understand and analyze how their funds and managers are voting. So this is a positive. You don't have to do anything. Again, just informational to let you know that these changes are being made.
Okay, any questions? Okay, thank you.
I do just want to make a note. I did attend the city council meeting, which I believe some of you are at. The ordinance did pass its first reading. This is the ordinance regarding the just change in benefit amount, just so we're up to date, but it will be on the agenda for the second reading at the next meeting. So just a note.
Okay, there's two of us there for that meeting.
Okay, great. Thank you.
All right, thank you. Next up, meeting schedule for 2023.
So we adopt schedule.
That's correct. We need to adopt the schedule of meetings.
We got you.
Burgess and Dwayne and have already been informed and had input into this schedule.
Pending quorums.
Yeah.
It's just a motion on the floor. Is there a second? There's a second as well. All in favor, say aye.
Aye.
Motion carries unanimously. Quickest report around. Next up is our quarterly expenditures. Ms. Kaiser has that up for us on the board. It's also printed in your packet. If you have any questions as it relates to the expenditures that are there, is there anything that you want to highlight, Ms. Kaiser?
Not really.
So everything is pretty customary. And you see everything in place, including the subsequent investments, or is there any question? If not, I'll entertain a motion to accept the expenditure report.
A motion we accept the expenditure reports presented.
Second.
There's a motion and a second. All in favor, say aye.
Aye.
Opposed, motion carries unanimously. Next up is public comment. Seeing that no one is in here, we'll open the floor for public comment and close it immediately. And so with that in place, we'll move on to item 10 with terms ending for both me and Mr. Cummings. Ms. Kaiser.
Yes, we have two openings on the board. If you know anyone who's interested, the one is a commission appointed, well, both are commission appointed positions. They would have to fill out an application with our city clerk, Sunny Krantz, and then be voted on by you in the committee, in the current committee. But we do need two more, otherwise we bump against our quorum limit of 3. So it's important to have other members for their viewpoints as well as for quorum. So somebody can be missing.
Okay. If there's nothing else before us, that takes care of our agenda for this meeting. I've enjoyed sitting on this board. This will conclude my business as chair of this board moving forward. And it's been a pleasure. Thank you, everybody.
Thank you for your service.
And so I'll entertain a motion to adjourn. Simultaneously.